Welcome to the Multifamily Investor Nation podcast. Looking forward to getting started and diving in with Tagge here. Going to be talking about Shelby Pointe Townhomes. It's purchased in May of 2020, located in Memphis, Tennessee, just down the street from the FedEx ramps out there. And looking forward to diving into this one. Before we get started, Sean, I want you to give the listeners a little bit of a background about yourself and kind of where you are right now in this multifamily space.
All right, man. Yeah, sure. So Tagge, I was, just like everyone, born and raised, get a good college degree, work your way up that corporate ladder. So I went to the University of Utah and got like the hardest degree I could think of, biomedical engineering. So a lot of medical devices, and was with all the pre-med students and all that. And I just figured I'd go and work on medical devices. So graduated, and I actually did artificial heart research for a few years after college. And it was a great job. It was awesome. It was fun, but I just was like, God, I'm just having to crawl up this ladder. I should go get an MBA or maybe a PhD and kind of just progress along in that field. And I was just like looking at retiring and all of that, planning it, and I was like, wow, well, the higher the return on investment you make, the better, right? And there's all these tax advantages. So I was doing stocks for a while, and I just finally found real estate. And it just clicked for me so much on all the benefits, all the great things about it. Like you mentioned, Dan, you just invest in real estate for tax advantages. Just that alone just knocks it out of the park. So it just made me so passionate about it. I ended up buying a duplex, and that's what got started for me, because the rent from the other tenant was covering my mortgage, house hacking. And that was back in 2015. Then I started looking for more rental properties, and I was in Salt Lake City, Utah at that time, and it was just a really expensive, overpriced market, as a lot of people are aware. And so I looked out of state and found Memphis, Tennessee to be one of the best cash flowing markets. So I bought a few properties over there. And then that's where I really met my partners. And about 3 or 4 years ago, I packed up my bags with my whole family, my 2-year-old daughter at that time, my wife. I quit my job, and I was like, I'm going full time into real estate, and partnering with my partners here, Jim and Brad Reedy, and started helping them out with their turnkey investment company. So selling single family homes. And I was really engineered, love numbers and all that. And they're more outgoing, like to work on stuff, just make things happen. So I kind of am the COO. I help with all the background of the systems, the processes, the numbers, the data, all that fun stuff. And so then over the past, we've been doing about 250 turnkey flips a year since 2017. Then really just the past year, we started looking into multifamily. We bought our first one about a year and a few months ago. And then we just closed, and we'll discuss, on our first syndication with investors on a 124 unit multifamily. So kind of just ramped up step by step to where now we're kind of in this newer space, discovering the multifamily syndication, and just real exciting.
So before we dive into this deal, talk to me a little bit about how that transition was with some of your investors, because it sounds to me like you guys already had like a list of people that had already been doing some of these turnkey rentals that they were buying from you. So they already had some success there. How was that transition, and from going from like these single family kind of turnkeys to getting them to be able to come into this kind of a syndication with you?
That's a great question. So it was so easy and so seamless, because we had a list of probably 5,000, 6,000 investors all over the country and world. A lot of guys have already bought from us, bought a turnkey. And then we really just got our pocket list of like, hey, these guys own 5 or 6 already with us. And they were already talking like, hey, I'm kind of maxing out all my Fannie Freddie loans, the 10 loans you can get. And they're like, I'm ready to sell a couple, and I have all this equity in my current house. What should I do? And we're like, we couldn't provide the inventory to really maximize all their capital, because they were looking to put 250,000, so on and so forth. And that would just take up a lot of rentals. So they kind of want to diversify, and we just found the multifamily to be the best way. And so me just kind of listened to podcasts like you and Joe Fairless and all those other guys. I was like, well, we could definitely do this. I mean, we already have a lot of the battle done with the list of investors, and a lot of them are already investing in other syndications. So we're like, well, let's just create this win-win, already have a great relationship, and can now give our investors, option one, buy a turnkey property, put 20, 30, 40 down, and have a great rental for you that you own all yourself. Or now you can partner up with us on a syndication and own a little slice of the pie, and you're investing alongside with us. So it's worked out great.
That's awesome. That's awesome. Well, let's go ahead and dive into this one called Shelby Pointe Townhomes, 124 units, Class C property. Purchase price was right at that $3.45 million price. But let's first, before we dive in too deep into this one, let's talk about the acquisition side of this. So how did you guys actually source and find this project?
Okay, so this one was through a broker, and What was really interesting about it was actually another apartment complex my partner bought a year or two ago. It's the same seller. So the sellers like worked out all these things. They wanted to sell this one and it came through the same broker again. So it was really good because number one, we've already closed on a property with this broker, had a good relationship with them, closed on time and all of that. And the seller knew as well. So it was really just the broker just knew it was in our area and just called right at us and we just let them know we're buying more. So pretty simple there. And yet again, like with brokers, there's only like what 5 or 10 in Memphis that even do a deal. So really easy to be friends with them and know them because there's just a few.
So was it fully marketed or was it just like an off market? Hey, do you guys want to take a look at this?
It was fully marketed, but we jumped in. He you know, a couple days before he's about to list it, we jumped in right on there with him. He just wanted to fully market it, because the seller requested that as well. But it was pretty easy pickings for us because we had the best track record to when we submitted our offer.
Sure. So at what point did you guys go and tour this property?
Got just the day or two after it was listed, we went over there. My partner, Jim Reedy, he's been in real estate 45 years and he specializes in renovations. That's his passion. That's what he's really good at. So he can go and walk a property and he's so smart in his head, just kind of has a great ballpark and it's eerily close to when we kind of write it all up. So we went over there and wrote it all up, got that budget and we submitted an offer and all of that and got it, after a couple of weeks of finagling back and forth.
So going through the entire process of submitting the offers, how many in this first round of offers actually submitted an offer? Like how many were you competing with?
I think there are about 3 or 4 others, so not too many, but a couple in that area. And I think actually what we're seeing on all of our offers, a lot of them are a little bit higher than ours, but they all have crazy contingencies. Also, most of the people are out of state. So, and what the broker usually notices is out of state, they just kind of throw out a shotgun of offers, aren't really familiar with the broker, aren't really familiar with the asset. We'll at least go and walk the property, which is pretty much like, quite a bit of the due diligence already for us, just our experience and knowing having our boots on the ground. And so our offer was a little bit lower. So the list price was $4 million and we submitted an offer of 3,450 and we're able to get it locked up for that amount.
Okay. And did you go through multiple rounds of offers or was it just kind of the first initial offer and they ended up just selecting you amongst the other buyers?
Yep, just the first initial offer. So we have had other times though, where it's been, hey, highest and best by Friday, but this one we were able to just lock up.
So outside of the track record, was there anything else in your terms that allowed you to be allowed you to be able to kind of stand out that allowed them to award you the deal versus somebody else?
Seriously, the fact that we just had a great talk with the broker, already knows us, the seller already knows we can close on a property with, and we're like, hey, look, we're not going to just give you some really low below what you're asking. We're going to get you a little bit below, justifying the repairs and all of that and everything. And we're like, look, we're going to close on this. You've seen us do it before. We're pretty much like, don't mess around with these other out-of-state guys who are going to go over there, lock it up, and then request $1 million reduction to their price they're offering. And that pretty much just did there. So just straight shooting, negotiating.
Did you have any earnest money that was hard day one?
No earnest money hard. There was $50,000 earnest money, subject to inspection and financing.
And what was the timeline for the closing?
So yeah, we had a 30-day due diligence from the time though the seller furnished all their due diligence docs. We've noticed with other sellers, we'll request the P&Ls and all these things. We don't get those till 2 weeks in the due diligence. So the 30 days started from when we were, we just had a little list of things we needed. Once we got that, 30 days from there. And then after the 30-day due diligence contingency is over, 45 days to close with the financing.
Was this a kind of smaller mom and pop type operator?
Yeah, so they were syndicators actually. So they syndicate, I believe 2 or 3 of them. I don't really know too much on the logistics on them, but I wouldn't say like a huge syndicator. So somewhat, and yeah, it wasn't. You'll see, it was definitely distressed upon buying and all of that. So there definitely was that distressedness in there.
How long had that seller held on to it?
Oh God, that's a good question. I actually don't know about that one.
Okay.
But I definitely think he bought somewhere, a lot of his he bought in the 2012. So he just bought at the pristine, perfect time to buy a multifamily. I mean, throw a dart anywhere and your property's appreciating a lot. So he bought it back in probably 2012, around there.
Okay. And did, It's another question I was thinking there. If I remember it, I'll come back to it. So
Sure.
let's kind of move into some of the due diligence process now. So now you got your offer, you got it accepted, you got the PSA inked. You did something very smart there, especially with a smaller type operator, of telling them that the due diligence period does not start until all the documents are in, which is great. So let's talk about now during this due diligence process. What are some things that maybe came up during this due diligence phase?
Okay. So first thing that happened is we locked it up like right before the COVID, right in March, beginning of March. So like a week or two later, we're just like, oh my gosh, what's going to happen? We manage a bunch of rentals. So we were just really, really scared about that. So we were preemptively discussing with the seller, like, hey, this is definitely a due diligence factor, COVID. Just let them know, hey, we might need to extend or something like that. Just getting that filler out there. But so we only actually extended a couple extra weeks just to kind of let the tide settle a little bit. And we saw our collection data was actually really good with what we manage here. I mean, we were only about 1 or 2% below our normal collections over the trending past 5 years. So we just saw that through April, and then we were seeing that in May. So we closed the end of May. So that was number one, was on that. Then due diligence. The big thing for us was getting the rental budget, line item and all of that and all the expenses. So a big lift. We had a $2.6 million reno budget on there because we just knew this asset, knew the seller before looking at it. So a big, heavy renovation. I mean, almost as much as the purchase price. And rightfully so. And the big part was, big value add was putting in washers and dryers. So we just had to figure out how to get the big amp electrical over there for that dryer, and then the vents for the washer, because currently the property had just an on-site laundromat, which wasn't really doing well either. So, that was just a big negative. And so that was our biggest way of being able to push rents. Average rents were $550, and we project to have rents at $700. So $150 a month rent bump just by putting in those washers and dryers. And then, of course, all the roofs need to be redone, the siding, HVACs. Just obviously a big, huge, heavy renter, like $20K a door. Yeah. 18.
So in addition, inside of these units that you're going to be renovating, what's the plan for doing that? Because obviously when you do the math on this, 3.45 million, definitely a Class C property, 124 units. It's roughly about what, $27,000 that you're buying it per unit?
27 a door, 27.8-ish a door. So yeah, definitely a big value add. It was about 60%-ish occupied. Rents were obviously way undervalued, even as is. They could have been bumped up. Not very well managed. All the documents were spotty here and there. We kind of knew that up front because we have bought another couple assets similar to this, distress and all that. And we kind of just knew, hey, let's write in our own numbers and projections, what properties we've already stabilized. So we kind of used a lot of our own data to project the stabilization, seeing how long it took to lease up the current property and renovate it and all of that. And then, what we really did was just got a couple bids from different electricians and plumbers on the vacant units, and they all had the same floor plan. So pretty easy to kind of project, to move in this, electrical panels, kind of newer, the 150 volt for the dryers, all of that. They gave us bids, and we kind of just used that per each unit and just kind of worked up, one unit, a big reno, then averaged it from there. So yeah, that was the big due diligence part, is just getting that reno dialed in.
What cap rate did you purchase this one at?
Sorry, what was that?
What was the cap rate that you purchased it at?
We really didn't even consider the cap rate, but cap rates in the area is around an 8 cap. So I don't remember too much on the financials before that because they were just all messy anyways.
Sure. You're spending quite a bit of money to renovate this thing. So I'm just trying to do some of the math here. If I add up the 2.6 million and the 3.45 million, you're going to be, right at about, 6 million plus. Obviously you're going to have additional fees and stuff like that you're going to have to add on top of that for some of the additional stuff that you've done too. So let's just say we're at 6.1 million, right? So right. 6.1 million, you're going to have to sell it at least for, 50,000 to break even on the deal. Yeah. What's the exit assumption as far as what you're going to be able to sell it for per unit?
Yeah. So we have another unit nearby called Graceland Flats that my partner owns, and he's been able to get that similar, is about 50-60% occupied when he bought it. He now has it at 95% occupied, pushing up into the 99-100 now, actually, pretty soon. And then he is working on the refinance on that. But yeah, our exit, let me pull that up here. So we have an NOI at year 9. So it's going to be a longer hold onto this one. We could sell earlier, but an exit of $8.4 million at year 9.
Okay. And what does that equate to as far as the returns for investors?
So a 17% plus or minus internal rate of return.
Okay. Okay. And you're bringing it from 550 to 700. And what's the stabilization time frame?
So yeah, 2 years is what we've done on our other unit nearby, is 2 years to kind of, rent all the vacant units. Then as the other leases expire, either, give them a rent bump or they move into another unit and we renovate that unit and fix it up.
Mm-hmm. Why do you think that this property was so low in occupancy? What's like is it just like the standard poor management from the prior owner?
So they wouldn't fix up any of the CapEx things. I mean, there were two burnt down, like partially burnt units on the property, and they just put a tarp over them. So I'm sure they got an insurance check and just didn't go and fix that up to get more rental on there. And then a lot of deferred maintenance, everything like that. So it seems like they just didn't want to put money into it to fix it up or something like that. Yeah.
Interesting. That just seems crazy. Like they would put all that, especially as a syndicator, to leave all that money on the line,
right?
And not want to fix it up to the point of being able to at least get the occupancy up to be able to sell it at the current space.
Right.
What's the market occupancy right now, or the market vacancy?
The market occupancy or vacancy is right around 90% or so, 90, 95, depending on the asset class and all of that.
Mm-hmm. Yeah. That's crazy that they did that, but I guess it's a good thing for you, right? I mean, you get the nice have all the nice extra, on top of that. So yeah. So let's talk about how you financed this deal. Talk about the lender and kind of some of the terms that you had on this.
Yes, used a local regional bank lender here, and what they did was a 76% loan to cost. So of the purchase and reno. Was the loan amount there. So we got a 4.65 loan, 4.75 interest rate. It was a 25-year AM with a 3-year term. So just a bridge, short-term bridge loan. Obviously wasn't up in that 90% occupied to get that Fannie Freddie financing. And then what was nice was it's 15 months interest only on everything. And then also the renovation, you weren't charged interest until you did the renovation draws. So that reno, 75% of the 2.6 million reno, just reno draws. We do like, $100,000 or $200,000 of the reno, then front the bills, then just get it reimbursed from the lender as we've been going along. Mm-hmm. So yeah, we're just in the process of renovating and all of that. So yeah, that was the financing pretty much.
Yeah. So what made you choose to go with a local bank versus another bank or another type of lender?
Number one, worked with them before, the ease of working with them, and also what we've seen just comparing other rates, kind of other bridge lenders, they're actually a little bit higher than this local regional person, where there are other bridge lenders, but they have more points and a little bit higher interest rates. So this one worked out pretty decent interest rate, we feel, for the bridge and the occupancy of what the property was.
Did your debt terms change once COVID hit?
So surprising, that was another thing we were very concerned about. So the lenders definitely took a little bit longer to kind of wait it out. What helped them is we showed them all of our collections data on a weekly basis from at least what we're managing. We have other multifamilies and single families. So that helped them feel comfortable being able to just continue on with the normal debt that they pretty much quoted us. I think they might have increased maybe 25 basis points on that interest rate, but not too much higher.
Yeah, there weren't very many bridge lenders in May that were giving out any loans either. So
right, yeah. So I guess just our track record, the fact that we're putting in a lot of our own capital into the deal and all of that, they felt confident with us.
Yeah, no, that's great. That's great. So how did you end up structuring this deal with your investors?
So yeah, it was of the just under $2 million raise to for the renovation, the 25% of the renovation, the purchase price, some closing costs. We raised some extra money for reserves, because that's what we learned on our other deal, was that there's always extra on the reno or operational things that come up. So we raised an extra $375,000 roughly 1,000 on top of, the closing cost and the down payment. So just shy of 2 million. So us as the partners put in, me, my partner, Jim Reedy, Brad Reedy, Mark Hart, and Jay Reedy. So there's 5 of us in the syndication. We put in combined as managers 725 of that 2 million capital. So we raised 1.275 million roughly from other investors. And it was a 9 pref with a 50-50 split.
Okay.
And we had about 12 other investors putting in money, anywhere from 50 grand minimum to 310,000.
Okay. And how many total investors outside of the partners are there?
12 roughly.
Okay. And how long did it take you to raise that last little bit?
Okay. So that was the fun part for us. Okay. So this is our first syndication too. So we've done other, we bought other apartments, and that's easy peasy. You just get an LLC, have your splits in there, and you're good to go. That takes, a day or two, read over the docs. So we were getting all the syndication docs, and, we're about a month out, we're like, okay, great, we can start working on that. But just getting with the syndication attorneys and writing out all the Class A, Class B investors as us as the managers, and there were just hundreds of pages on there. So that took an extra 2 weeks, because, just when you have to change something, it takes another couple of days for the attorney to write it up, then a couple of days for us all to read it. So we only had about 2 weeks before closing when we actually sent out our offering to investors. So we were a little freaked out, because number one, we're raising 1.2 million, not an easy lift for your first one. We felt, our first syndication, but we managed to make it happen, because we were kind of telling our investors once we locked it up, hey, we're going to send one to you, be ready, have your funds ready. But we couldn't send out anything until, chicken before the egg here, before we had all the legal docs lined up. So that was the tricky part. So we were sweating a little bit raising that money in 2 weeks, but man, we actually were able to get it all funded, and actually had, about 200,000 extra that we had to turn down to put into the deal. So that was definitely a really fun experience, a little sweating as well, as you can imagine.
Did you do a 506 Bravo or Charlie?
Yeah, so this was a 506 Bravo. So we could accept, obviously investors that invested with us, bought a single family from us. So sophisticated investors, but I'd say most of the investors were accredited investors, but we did have a few sophisticated investors that have had a long-term relationship with us. So
yeah. And obviously being at 12 investors, you're not really worried about hitting that cap of 35 anyway. So it wasn't really a major issue.
Yeah. We won't have a cap of 35 sophisticated investors. So worked out pretty well, but definitely fun on that end.
Yeah. So on your next one, are you going to try to do a 506C, or you're going to try to stay with the 506B for now?
Yeah. So speaking of what, we just closed on one on Friday, 128 unit nearby as well, kind of similar plan. And we did a Bravo on that one. We still don't need to be marketing publicly to make it a 506C. A lot of just our inner pool of investors are still interested. So as of right now, we don't really need to.
Yeah.
But futuristically, once we tap out of our list of 5,000 investors, all that capital that they put into deals, we will go into a 506C and start really publicly marketing and all that.
Yeah. No, that's great. So can you think of anything else that came up during the process that we have not talked about that might be important for the listener?
Okay. So I definitely think get working when you're reading over those syndication documents with the 506B, 506C documents, try to get that up front, but you kind of do have to wait till you have a deal and have all the due diligence done to really pay those attorney fees to get all those docs ready. But read over all of that, make sure you're crystal clear on all your splits of what you want, but it's just something you got to do. You got to read the docs, have some adjustments. That was the big thing. I mean, then just the curve, it was like 2 curveballs, number one, just first syndication, then also just kind of through a pandemic, really couldn't plan for that. But we just used all of our data of what we currently have on the collections and adjusted from there. And it did work out well for us. So that'd be my advice.
Well, I have 2 final questions for you. So they're kind of contrasting questions. I ask them with every listener, not every listener, but every podcast guest. And the first question is, what did you find that was easier during this entire process that maybe in the beginning you thought was going to be a little bit more challenging?
Okay, so we thought the money raise we thought it'd be really hard and tricky, especially in 2 weeks, but that was actually a little bit easier because we had such a big list, which is different than most people. Most people don't have a big list of investors up front, but from us doing the turnkey, that was easier. Yeah, so that was probably the easier part. And then also just an update, we've owned it for roughly 4 or 5 months now. We had projected rents of $695. we were actually getting like crazy applications of people walking through the door wanting to rent out this place. Cause in this little sub market, there's really no inventory of like freshly renovated Class C priced assets in here. So we're just getting crazy leasing applications and foot traffic in the door. And because of that, and our on-site manager, she's been communicating, we've been able to raise rents to $750. So we've leased about 10 or 12 at $750, which is way hitting our projections because we had $695. And so that was what was surprising too, is just gathering that would be something on your due diligence, is calling other apartment units and just really looking at the asset classes nearby and what the lease volume and applications are. If you had that data from other apartments nearby, that can really help you know how quickly you can lease it up and for what price. Mm-hmm. So we were overwhelmed and we're able to raise the price $50 extra on what we projected.
What's the occupancy now?
So yeah, we're right now just creeping up into the 60%. Had to get out a few people right at the beginning. So it's like we had it at 60, dipped down a little bit, had to get out a few people that weren't screened correctly, not paying and all of that. Now we're back up to around the 60% and going on from there.
That's awesome. So how many, you already have renovated 12 of those units and leased them out for $750?
Yes. Leased, already occupied in there. We actually rented one out at $775, but found $750. That's a sweet spot. We rented also a couple at the $725.
That's awesome. That's great. Well, the final question I have for you is what did you find was harder and that you had maybe originally thought was going to be a little bit easier?
Yes, the syndication documents, from the syndication attorney, definitely a little bit harder. It wasn't hard like reading over them, but just getting exactly the structure you want, the splits, and all of that between your partners and your investors and all of that. That was probably a little bit longer, trickier for us on that end. And then, that was pretty much it.
So was that part easier now on your second one that you just closed last week?
Yes, so much easier because I knew exactly what to say up front. I really suggest actually drawing like an org chart. So like, here's the asset in the LLC. It's going to be controlled by, these other LLCs, and then the splits are going to be this way and that way. So kind of like mapping it out on if you've ever used like Google Draw or Mind Map, that really helped kind of just having the org chart. And then that way, me and the attorney and all of us know exactly what type of structure we want. So definitely would suggest that. Yeah.
Now your SEC or your securities attorney, are you using a separate securities attorney, or is it the transactional attorney that just kind of helped you with the syndication docs?
So we use Trowbridge Law Group. They're great. They're all over. He's Gene and John. So we use them, and then of course had our own title closing attorney here.
Yeah, that's great. Awesome. Well, I have no further questions for you, Sean. I really appreciate you jumping on and sharing with our listeners here, and would love for you to share with the listeners how they can reach out to you if they have further questions about this project or maybe a future project that you're working on.
Yeah, sure. Thank you so much, man. That flew by really quickly. Anyways, MemphisInvestmentProperties.net is our website. You can contact us there, and we'd be happy to talk about anything. And I'd be happy to share my experience with anyone. I'm an open book and definitely enjoy calling people from newbies to veterans. Love networking with other people. So,
Awesome. Well, thanks again, Sean, for coming on, and looking forward to continue to follow you as you continue to close more deals.
Awesome. Thank you so much, Dan. How are we going?
All right. Thanks, Sean.